Hello everyone, my name is CMA Pankti. Veni, welcome back to CMA modules. In this video lecture, we will be recording accounting standards. First accounting standard, disclosure of accounting policies, AS1. So we need accounting standards. Okay, we need some standards to perform our accounting. Suppose I am also performing my accounts, and even Mr. A is maintaining his accounts. So I will follow my rules, my regulations, and Mr. A will follow his rules, his regulations. Now, suppose any investor or any customer or any supplier wants to deal with both of us, wants to compare, he will not be able to compare the transactions. He'll not be able to compare our financials. But at the same time, if we are preparing using same set of rules, same set of standards, then in that case he can prepare. So we have disclosure of accounting standard AS1. This standard deals with disclosure of significant accounting policies followed in preparation and presentation of financial statements and is mandatory in nature. The accounting policies refer to specific accounting policies adopted by the enterprise. Proper disclosure should ensure meaningful comparison both inter and intra. So we have set of accounting standards, and these set of accounting standards will help us to go for comparison, will help us to take many decisions. So we have first standard, and first standard is related to disclosure of accounting policies. So what is this standard about? This standard is about disclose everything. Disclose everything. Whatever you are doing, whatever smallest changes you are doing, you disclose that change in your financials. So this standard deals with disclosure of significant accounting policies followed in preparation and presentation of financial statements and is mandatory in nature. This standard deals with what? This standard deals with disclosure of significant accounting policies followed in preparation and presentation of financial statements and is mandatory in nature. Accounting policies refer to specific accounting principles adopted by the enterprise. Accounting policies refers to specific accounting principles adopted by the enterprise. What is accounting policy adopted by that particular enterprise? Now, proper disclosure would ensure meaningful comparison. There should be proper disclosure. With the help of that, we can do meaningful comparison between inter companies and intra companies. Financial statements are intended to present a fair reflection of financial positions, financial performance, and cash flow of an enterprise. Financial statements are intended to present a fair reflection of the financial positions, financial performance, and cash flow of an enterprise. Correct. Financial statements always help us to show fair position. Okay. Then areas involving different accounting policies by different enterprises are methods of depreciation, methods of depletion and amortization, treatment of expenditure during construction, treatment of foreign company conversion or translation, valuation of inventories, treatment of intangible assets, valuation of investments, treatment of retirement benefits, recognition of profits on the long-term contracts, valuation of fixed assets, treatment of contingent liabilities. So we have areas involving different accounting policies by different enterprise, different accounting policies. I can have different policy, Mr. A can they have different policies. So in which all areas, below mentioned areas, methods of depreciation, depletion and amortization. Then treatment of expenditure during construction. So suppose I'm performing construction activity, different methods I can obey for recording construction expenditures. Treatment of foreign currency conversion or translation, valuation of inventories, treatment of intangible assets, valuation of investments, treatment of retirement benefits. So these all are list of items, list of areas wherein I can have different accounting policies. Fundamental accounting assumptions. Certain basic assumptions in the preparation of financial statements are accepted and their use are assumed. No separate disclosure is required except for non-compliance in respect of going concern, consistency and accrual. So we have going concern, consistency and accrual. So what is going concern? Continuing operations in foreseeable future and no interim necessity of liquidation or winding up or reducing scale of operations. So we have going concern. Going concern means company will go on forever. Company will go on forever. I am not there, but still company will be there. So company will go on forever. Continuing operations in foreseeable future and no interim necessity of liquidation or winding up or reducing scale of production. So that is going concern. There is no interim necessity. There is no requirement of winding up of the company or liquidation of the company or scaling down of operations. Consistency. Accounting policies are consistent from one period to another. Accounting policies are consistent from this period to another period. They don't change. From one period to another period, accounting policies are consistent. They are same. Accrual. Revenues and costs are accrued. That is, they are earned or incurred and recorded in the financial statements. Accrual. So suppose Mr. A will come and he'll tell me, you please give me 10,000 water bottles, but payment I'll give you next month. So I will not record sales. No, I'll record this as sales. Accrued sales. Accruals. Revenues and costs are accrued. That is, they are incurred, but they are not earned. Okay, I'll get money after 30 days. I'll not record. No, I'll record as accrual. So certain basic assumptions are going concern, consistency, and accrual. Going concern, consistency, accrual. Okay, so these are the assumptions. Then factors governing selection and application of accounting policies are prudence, substance over form, materiality. So what is prudence? Generally, maker of financial statements has to face uncertainty at the time of preparation of financial statements. These uncertainties may be regarding collectability of receivables, number of warranty claims that may occur. Prudence means making of estimates which is required under conditions of uncertainty. So we have prudence. What is prudence? Prudence means generally maker of financial statements face uncertainty. Maker of financial statements face uncertainty. At the time of preparation of financial statements, these uncertainties may be regarding collectability of receivables, number of warranty claims that may occur. Prudence means making of estimates. What is prudence? Making of estimates which is required under condition of uncertainty. Then we have substance over form. It means the transactions should be accounted for in accordance with actual happening and economic reality of transactions, not by its legal form. So we have substance over form. Substance over form means it means that transactions should be accounted for in accordance with actual happening and economic reality of the transactions, not by its legal form. Like in hire purchaser, if assets are purchased on hire purchase by hire purchaser, the assets are shown in the books of hire purchaser in spite of the fact that the hire purchaser is not the legal owner. So substance over form means in spite of the legal form, uh, it should be accounted for in accordance with the actual happening, in spite of the legal form. So they have taken an example of hire purchase. Though we know hire purchaser is not the legal owner, but still we will show a set in his books of accounts. Then we have next materiality. Financial statements should disclose all the important all items and facts which are sufficient enough to influence decisions of the readers or users of financial statements. So we have financial statements, and these financial statements should disclose all the items and facts which are sufficient enough to influence decision of the reader or user of financial statements. As to the disclosure of all material items, individually, all in aggregate in the context of the fair presentation of financial statements, as a whole, if the omission or misstatement could influence economic or financial decisions of user relying upon the financial statements, depends on size of the items or errors judged in the particular circumstances of its omission or misstatement. So we have materiality. Materiality means all important. Okay, materiality means relevant, all important. So as to the disclosure of all material items individually or in aggregate in the context of file presentation of financial statements as a whole, if its omission or misstatement could influence the economic or financial decisions. So, materiality means anything important which is relevant for my particular period that I'm supposed to take into account. If it is not important, not relevant, please ignore it. Then we have changes in accounting policy. Suppose you are following above assumptions, above concepts, then you are not required to, what to say, disclose. But suppose if you are making any change or you are not following it, then you are required to, what to say, you are required to disclose them. So, any change in accounting policies which has a material effect in current period or which is reasonably expected to have a material effect at the later period should be disclosed. In case of change in accounting policies having material effect in current period, the amount by which any item in the financial statement is affected by such change should also be disclosed to the extent as ascertainable. Otherwise, the fact that the effect is not ascertainable should be disclosed. So, we have changes in accounting policies. So, any change in accounting policies which has a material effect in the current period or which is reasonably expected to have material effect, okay, that needs to be informed, that needs to be disclosed. The following are not considered as changes in accounting policies. Accounting policies adopted for events or transactions that differ in substances at present. Accounting policies pertaining to events or transactions which did not occur previously or that were immaterial. Okay. So which was not material, which was not important. The policies which were not adopted are related to events or transactions which are yet not adopted. So such policies we can disclose later or we can avoid to disclose. I hope you are comfortable till your disclosures of accounting policy, this accounting standard one, and we are required to disclose all these standards. The standards which are followed or methods which are followed by the company for depreciation and for different areas. Then we'll go for sums. Jeevandip Limited had made a right issue in 2020. In the offer document to its members, it had projected a surplus of Rs 40 crore during accounting year to be ended on 31st March 2022. The draft results for the year prepared on the hitherto year 2 followed accounting policies and presented for perusal of the board of directors showed a deficit of rupees 10 crore. The board, in consultation with managing director, decided on the following: value year end inventory at work cost instead of year 2 mentioned of valuation of inventory at prime cost. So different factors are given and you are required to answer them which accounting policies we are required to follow, we are required to disclose. So accordingly, you suppose if inventories are valued at some method, so you need to disclose that method, depreciation method. So accordingly, you are required to answer. Same way, we have short notes, we have different types of sums here. So 4 to 5 sums they have given under accounting policies. Need to go through all of them. Accounting standards are little important. They are important for 20 to 25 marks. You can get direct question. Write a short note on accounting standard 1, accounting standard 10, or else you can get MCQs, you can get one word, you can get small answers. You can get numerical problems. Accounting standards are very, very important. I hope you are comfortable with this lecture. For next accounting standard, we'll come up with one more lecture. Thank you.